Welcome back to the Deep Dive. This is the show where we take a huge stack of complex professional information and, well, we boil it down into the tools you need to sound like the smartest person in any room.
Today, we are definitely getting into the weeds. We're moving past those, the glossy headlines on financial reports and getting into what actually matters, investment performance evaluation.
Right. Because it is so easy to see a big dollar number and just assume, hey, that's a success.
And it's often not the full story. That number it can often be lying to you about the quality of that return and, more importantly, the risk you had to take to get it.
Absolutely. So for this deep dive, we have been given a pretty comprehensive stack of professional Q&A material. We're talking 50 key concepts that financial experts use to measure success. So our mission today is, well, it's a true masterclass. We're going to give you the metrics and, just as important, the context you need to move beyond those simple dollar amounts. We want you to truly understand the risk, the reward, and the relevance of any investment decision you make.
And look, in a world that is just saturated with complex financial data, all this hype, understanding how professional fund managers measure and dissect these numbers, things like the Sharpe ratio or beta, that's probably the biggest shortcut to being genuinely well-informed.
So we're not just looking at the size of the return.
Not at all. We are assessing the efficiency, the quality of that return.
Okay, let's just dive straight in then. Before we can even get to risk, we have to really understand what's making up the returns you're seeing in the first place. So we're moving past just the unit value, and we're dissecting the anatomy of a return.
Right. And our sources are really clear on this. Investment returns, they don't just come from one single source. They actually come from what we can call three primary pillars.
Okay, so 3 pillars. What are they? If I'm looking at a performance report, what am I actually seeing?
So first, you've got your periodic income. Think of this as the regular, sort of predictable cash flow. So interest payments from a bond or dividends from a stock.
Okay, the stuff that hits my account regularly.
Exactly. That's often the most stable part. Second, you have capital gains or losses. Now, this comes purely from the change in the investment's underlying market value,
The price going up or down?
the price going up or down, appreciation or depreciation. And the third pillar, of course, is just a combination of both of those.
And that framework, it immediately shows you the huge difference between different types of investments. If I look at, say, a fixed deposit in a bank, the return is almost entirely that periodic interest income.
Almost 100%. There's really no capital appreciation component to speak of. It is an income-driven asset, plain and simple.
But then you compare that to, let's say, an aggressive equity mutual fund.
A completely different animal. When you calculate the total return for that equity fund, you might get a little bit of income from dividends, but the overwhelming majority of the performance is coming from the increase in the net asset value, or the NAV.
And that NAV increase is the capital appreciation.
It is. And the key is you have to include both. The total return absolutely must include dividends you received and the changes in that NAV. If you only look at one, you can't accurately measure the performance.
This brings us to something that I think really trips up a lot of new investors because it doesn't feel real. It's not cash that's suddenly in your bank account.
Yeah.
We have to talk about unrealized or notional gains. What are they and why are they so important for this calculation?
They are absolutely essential. And the reason is they represent the true change in your wealth right now. Unrealized gains or losses they're reflected in that change in the market value of the asset, the NAV.
So even if I haven't sold it?
Even you haven't sold it.
Yeah.
The profit hasn't been, crystallized into cash, but that gain or loss must be included in your total return calculation. It's not optional.
So if I bought a mutual fund unit for $10 and today the NAV is $14, I have a $4 unrealized gain per unit. And even though I haven't cashed out, that $4 counts towards my total return for this period. If I only counted, say, the 10-cent dividend I got, I'd be massively understating what happened.
Massively. You'd be missing the biggest driver of performance, especially in volatile things like equities.
Yeah.
That capital appreciation part often makes up 90% or more of the total returns.
Right.
And that huge difference, between your $4 unrealized gain and the 10-cent dividend. That's why equity volatility, or risk, comes from those constant swings in value. You're always gaining or losing wealth that's just sitting there on paper.
And that paper value is what your portfolio is worth today.
Exactly.
Okay, so we know what a return is made of, but now we hit the next big problem, which is standardization. It's totally meaningless to compare a fund where I invested $1,000 and made 100 against one where you put in 100,000 and made 2,000. Not if we only use the absolute dollar amount.
And that is precisely why the percentage return is mandatory. It's non-negotiable.
Just levels the playing field.
It completely eliminates the distortion that you get from different principal amounts. You convert every investment's return to a base of, say, 100 units invested, and suddenly you have immediate comparability. It doesn't matter how much capital you started with.
So using your example, my $100 gain on $1,000 is a 10% return. Your $2,000 gain on $100,000, that's only 2%.
Right.
The percentage just cuts through the noise and tells me my money was working much more efficiently. It's that essential step of normalization.
But even after you do that, after you get that percentage return, you still have an incomplete picture if the investments were held for different amounts of time.
Ah, the time element.
The time element. A 10% return over 6 months is fundamentally, I mean, it's twice as good as a 10% return over a year. This is where we have to introduce annualization.
Annualization. So converting a return, no matter how long I actually held the investment, to a theoretical 1-year holding period, the return per annum.
Exactly.
Yeah.
You have to do it. If Fund A gives you 5% in 6 months and Fund B gives you 8% over 18 months, you can't logically compare them as they are.
Right.
You have to annualize Fund A to, roughly 10% a year and then figure out the annual rate for Fund B. Only then can you actually see which one is the better use of your capital over time. It's a non-negotiable step for evaluating performance.
So when we start talking about longer-term success, especially for anything held over a year, we land on the industry standard, which is CAGR, the compounded annual growth rate.
Yes, CAGR is the accepted, the professional measure for any multi-year horizon. And it's because it solves a core problem. It accounts for two really important concepts: the power of compounding returns and the time value of money.
So it's not just a simple average.
No, it calculates the smooth average annual rate at which your money grew over the entire period, but it does it assuming that all your profits were consistently reinvested along the way.
The formula itself can look a bit scary when you write it out, but if we break it down logically.
The logic is simple enough. You first find the total growth factor, so you divide your end value by your beginning value.
Okay.
Then you have to smooth that growth out over the whole time you held it. You do that by raising that result to the power of 1 divided by the number of years, N, as they call it.
And then just subtract 1 to get the percentage.
And subtract 1 to get back to the annual rate. It's essentially finding the geometric average rate of growth.
Yeah.
It's the proper way to average growth over time.
Now, this sounds perfect, but this is where we hit our first really big caveat, the first warning sign about the quality of a return, the average trap, as professionals call it.
Yes. The big caveat with CAGR is that, by its very definition, it is an average return over the entire period. It perfectly masks the underlying volatility.
The journey.
The journey the investor actually took to get that average. And that is a crucial distinction.
So the practical impact is, because the returns were all over the place, an investor who maybe came in late or got out early, they could have had an experience that looks nothing like that final KGR number.
Nothing at all. If a fund reports a 12% 5-year KGR, but in the middle of that it had a year that was plus 40% and another that was minus 20, well, a person who only invested during that down year saw absolutely no resemblance to that 12% average.
And that gap, that deviation between the smooth advertised KGR and the actual bumpy year-to-year returns, that's basically the definition of risk, isn't it?
That is the fundamental definition of risk in finance.
Okay.
The quality of that 12% return is defined by how big those swings were from year to year.
And this gets even more complicated in the real world because most of us don't just make one big investment and let it sit. People use systematic investment plans, SIPs. Money's flowing in all the time.
Correct. So we need a metric that can handle multiple cash flows at different times.
And that's where we get into things like XIRR.
Exactly. The professional standard is something called the money-weighted rate of return, or MWR. For personal investors who are tracking these irregular cash flows, the go-to tool is the XIRR function in Microsoft Excel.
Okay, let's pause on that because there's a really important professional distinction here. Why do we, as individuals, use something like XIRR, but a fund manager reports something else, the time-weighted rate of return, or TWR?
Ah, that is an excellent question. This is where we move from just tracking your own results to fairly evaluating a manager's skill. XIRR, your money-weighted return, is heavily influenced by when you put your money in or take it out.
So it's measuring my timing as much as their performance.
Precisely. If you just happen to invest a big lump sum right before a huge market rally, your XIR is going to look fantastic. But that's because of your good timing, not necessarily the manager's stock picking skill.
I see. So XIRR reflects my personal experience, which is what I want for my own records, but it would unfairly bias the evaluation of the fund manager.
Exactly. So TWR, the time-weighted return that professionals use, it mathematically strips out the effect of those cash flows. It calculates the performance of the portfolio itself as if no money moved in or out.
So it isolates the manager's skill.
It isolates the manager's skill. So when you're evaluating a manager, you look at their TWR. But when you're tracking your own personal journey with all your contributions, XIRR is the correct reflection of your average rate of return.
And for anyone using XIRR, the details are everything,
All right.
especially the sign convention. What's the rule here?
The discipline on signs is non-negotiable. It has to be right or the number is garbage. When you put your data in, cash outflows, that's the money you invested, must have a negative sign, A-,
Okay.
and cash inflows, dividends you received, or the final amount when you sell, those have to be positive. If you mix up those signs, the calculation will just produce nonsense. It's a powerful tool, but it demands you be a strict bookkeeper.
This whole section really drives home that performance evaluation isn't just simple math. It's about standardization, accounting for time, for cash flows. But like we said, KUVARR, they're only half the story. Now we have to face the dragon, volatility and risk.
Right. And we have to start with the most fundamental definition of risk. In investing, risk is defined as what happens when the actual return you get differs from the expected return you thought you were going to get.
I like that definition because it's not emotional. It's not about fear. It's just about measurement. I might expect a 10% return if I get 15 one year and 5 the next. That 5% deviation in either direction, that's the risk we're measuring.
That unpredictability is exactly how we quantify it. Risk is measured by the magnitude of the fluctuations, the deviation in returns, when you compare them to the average return.
So if the returns are swinging wildly all over the place year after year,
Then that investment has high volatility and therefore high risk. The whole goal of a low-risk investment is for the actual returns to cluster very, very tightly around that expected average.
and the main statistical tool used everywhere to quantify this deviation is standard deviation, SD.
Standard deviation. It quantifies how much an investment's returns fluctuate relative to its average over a period. It's the accepted volatility scorecard in finance.
And the rule is simple?
The rule is very simple. A higher standard deviation means a greater range of possible outcomes, which means greater volatility and greater risk. End of story.
Let's go back to our earlier example. Fund A, which earned 10% every single year, versus Fund B, which had a plus 30% and a minus 10% year, but also averaged 10%.
Fund A has a standard deviation of basically 0. It's stable, it's predictable. Fund B has a very high standard deviation, which is a signal to you, the investor, that you better be prepared for some extreme swings to get that average.
And this is why it's used for benchmarking. You compare a fund's SD to the market's SD.
And it tells you how much extra risk you took on to get your returns. If your fund's standard deviation is twice as high as the market's, but you only beat the market by 1%, well, that was a grossly inefficient use of your risk budget.
But I want to bring in a professional critique here, because standard deviation is the standard. But a lot of pros, especially in fixed income, they don't love it as the only measure. Why is that?
That's a great point. The fundamental flaw, if you can call it that, of standard deviation is that it's symmetrical. It treats volatility to the upside, getting 30% when you only expected 10, exactly the same as volatility to the downside.
And nobody complains about a positive surprise.
Nobody. So if you're managing a conservative retirement portfolio, what you really care about is minimizing the downside risk, not necessarily all volatility. And that's why more sophisticated investors will look at other metrics, like the Sortino ratio. It's a variation of the Sharpe ratio, but it only uses downside deviation. It only penalizes the volatility that falls below what you need, which gives you a much cleaner picture of how well a manager protects your capital in bad times.
So we use SD because it's the market standard, but knowing its limits is what makes you a smarter investor.
Exactly.
Okay, let's break risk down into its two main types, because one of them you can control and the other you can't. Let's start with the controllable one. Unsystematic risk.
Unsystematic risks are the ones that are specific to a single company or maybe a single industry. Think of a product recall at one car company or a scandal at a specific bank.
Something that doesn't affect the whole market.
Right. And the good news is this type of risk can be reduced or even pretty much eliminated through good diversification. If you spread your money out widely enough, the failure of one single stock is just a small blip in your overall portfolio.
And then there's the risk we just have to live with, systematic risk.
Systematic risk is the macro stuff. It applies to the entire market all at once. It's the unavoidable things.
Yeah.
Inflation, political crises, pandemics, recessions.
Things you can't diversify away from.
You can't. No matter how many stocks you own, if the entire economy shrinks, systematic risk is going to pull your portfolio down. It's also called market risk for that reason.
And since we can't avoid it, we need a way to measure how sensitive any particular investment is to that big market-wide tide.
And that brings us to beta.
Beta. So what is it measuring?
Beta measures the volatility in a stock that is specifically caused by systematic risk, by the market moving. It's essentially the investment's response rate to the market as a whole. And we define the market itself, the index, as having a beta of 1.
Okay, so wait. Standard deviation measures total volatility, the company's own issues plus the market's issues.
Correct.
But beta isolates only the volatility caused by the market.
That is the critical distinction. And that beta number, it tells you so much about an asset's personality. If a stock has a beta greater than 1, it's considered more volatile, more risky than the overall market.
And less than 1, it's more stable.
More stable, more defensive, exactly.
Let's use the actual example from our source material. A stock has a beta of 1.1. What does that tell an investor?
That 1.1 means the stock is expected to move 10% more violently than the market, up or down. So if the market index goes up by 10%, that stock is expected to go up by 11%.
But the reverse is also true.
And this is the crucial part. The reverse is also true. If the market falls by 10%, that stock is likely to fall by 11%. It accelerates the loss.
It's a double-edged sword. So when would a manager deliberately go looking for these high beta stocks?
You do it strategically. If you have a really strong belief that the economy is heading into a powerful, sustained bull market, you want high beta assets. They're like an accelerant for your returns.
And if you're worried about a recession,
then you do the opposite. You shift your capital towards low beta assets, things with a beta of less than 1, because they're expected to fall less than the market.
Yeah.
They offer a defensive cushion. So beta is really a strategic lever you pull based on your view of the whole economy.
Okay, we've got the tools to measure risk. Now we come back to the big question. Why even take the risk in the first place? Why would I choose that wild Fund B when Fund A is so stable?
You have to be compensated for it. It's a core principle of finance. A higher risk investment absolutely must be justified by a higher expected return. We call that the risk premium.
So I need to be paid extra for the headache, basically.
You need to be explicitly compensated for bearing that extra unpredictability. If a risky asset and a safe asset offer the same exact return, a rational investor is always going to choose the safe one.
Which brings us to the risk-adjusted reality. We need one metric that can pull all of this together, the return, the risk, and answer that one fundamental question: was the return I got actually worth the risk I took?
And that one metric is the Sharpe ratio. It's considered the gold standard in finance for measuring risk-adjusted return. It calculates how much return you generated for each unit of risk you took.
So this is the ultimate decider. If I have two funds, they're in the same category, they both returned, say, 12% last year. But Fund X has a Sharpe ratio of 0.8 and Fund Y is 1.2.
You absolutely must prefer Fund Y, the one with the highest Sharpe ratio.
Because this was more efficient.
It was more efficient. It generated a much bigger excess return for the amount of volatility it put you through. It's a sign of superior risk management skill.
Let's break down the formula for everyone listening because it really shows how it combines everything. It's the investment return minus the risk-free rate of return, all divided by the standard deviation.
Right. And look at that top part of the fraction, the numerator. Your return minus the risk-free rate. The risk-free rate is what you could have earned with zero volatility, like from a short-term government bill.
So the difference is the bonus I got for taking a risk.
It's the excess return, the explicit compensation. And then we divide that compensation by the standard deviation, which is the total risk you took. It literally tells you how many units of risk premium you earned for every unit of volatility you endured.
It perfectly captures that justification idea. You need a positive Sharpe ratio just to bother investing at all. And the highest one among similar funds tells you who's doing the best job of turning risk into reward.
And if you see a negative Sharpe ratio, that means you took on risk and got a return that was worse than just sitting in cash. you would have been better off doing nothing.
Now, all of these metrics, SD, beta, Sharpe, they all need a comparison point, a benchmark. But the comparison is useless if the benchmark isn't, as sources say, relevant or suitable.
That relevance is everything. The benchmark has to accurately reflect what the fund is actually doing.
Give us a clear example of a mismatch.
Okay, let's say a fund manager runs a really high-risk portfolio of small-cap tech stocks, aggressive stuff. But they choose to benchmark their performance against the Nifty 50 index, which is all large, stable, blue-chip companies.
That's a bogus comparison.
It's completely invalid. A small-cap tech fund should crush the Nifty 50 in a bull market just because it's inherently riskier. The manager might look like a genius on paper, but they haven't proven they can beat the right benchmark, which would be a small-cap tech index.
And this is true for debt funds, too. You can't compare a short-term bond fund to a long-term bond index.
Absolutely not. The tenor, the time until the bonds mature, has to line up. A short-term fund just has a completely different risk profile from a long-term one because of interest rate risk. You'd be comparing apples and oranges.
So the whole point of a good benchmark is to see if active management is actually adding any value. What's the core expectation there?
The expectation is that they generate alpha. That's the value the manager adds above the benchmark. And it means two things. The fund has to rise more than the index in a good market, and just as important, it has to fall less than the index in a bad market.
If it's just tracking the index.
Then you should fire the manager and just buy a cheap index fund.
Finally on this, a word of caution about comparing funds to their peer group. It is so tempting to just look at a list and pick the one with the highest return.
It's a classic trap. You have to look past the return number and ask how they got it. What was the risk involved? A fund might be at the top of the list, but it got there by taking some truly insane risks, like piling into one speculative sector.
And you'd see that in its standard deviation.
You'd see it in the SD, and you'd see it in a potentially lower Sharpe ratio. Performance without the context of risk is just marketing. It's noise.
Okay, let's shift from metrics to strategy. Let's talk about why someone might pay for professional management in the first place, especially when you hear that so many active managers don't even beat their benchmark after you subtract their fees.
That's a very fair challenge, and the data on fees is real.
Yeah.
But the value of a managed fund, especially for, the average person, it rests on a few structural benefits that go beyond just trying to beat an index.
Okay, what are those benefits that can justify the cost?
First is simply expertise and discipline. A good manager is paid to do this full-time. They assess trends, they have access to information, and they make decisions based on data, not emotion.
They're a firewall against my own panic.
They are.
Yeah.
The biggest enemy for most retail investors is their own greed or their own fear. A professional is paid to be disciplined, to buy when others are panicking, and that emotional distance is a huge, huge advantage over the long run.
Okay, what's second?
Diversification. Plain and simple. By pooling everyone's money together, a fund can achieve a level of diversification that you just couldn't get on your own. They can own small pieces of hundreds of different assets.
So it neutralizes that unsystematic risk we talked about.
It completely neuters it. The failure of one company is basically a non-event. And the third benefit, which I think is often overlooked, is access and liquidity.
What do you mean by access?
Well, funds can buy into investments that have very high minimums, things that are just out of reach for a normal investor. Institutional bonds, certain private placements. Plus, they provide liquidity. Even if the fund holds assets that are hard to sell, you, the investor, can always redeem your unit at the current NAV. You can get your money out.
Right. So moving on to designing a portfolio, the strategy has to change based on your time horizon, right? Accumulation versus distribution.
It has to change dramatically. In the accumulation stage, when you have a long time horizon, say 20+ years to retirement, the objective is pure growth.
And that's when you can justify taking on more risk, like with equities.
That's the only time, really. That long horizon is your biggest weapon because it gives you time to recover from the inevitable downturns and let compounding do its work for better long-term returns.
But then as you get closer to that goal, close to retirement, volatility, which used to be just an annoyance, it becomes your mortal enemy.
It becomes lethal. This is the distribution or pre-retirement stage. And the goal has to shift to principal preservation. The reason volatility becomes so dangerous is something called sequencing risk.
Meaning the sequence of returns matters.
Immensely. If the market crashes right before or right after you start taking money out, you're forced to sell your assets at a loss, and that can permanently cripple your portfolio's ability to ever recover. So at this stage, you have to rebalance towards lower volatility debt instruments.
But what if there's a conflict? What if someone has a really long time horizon, say 25 years, but they have a very low risk tolerance. They can't sleep at night when the market swings. What rules?
The risk tolerance has to rule.
Yeah.
Always. Even with a long horizon, if an investor can't stomach the volatility, they must choose mostly debt investments.
Why?
Because an anxious investor is going to do the wrong thing. They're going to panic and sell at the absolute worst time, locking in their losses. Your psychological comfort and your ability to stick with the plan will always trump the theoretically higher potential return. Consistency is key.
Let's drill down into the portfolios themselves. What actually drives the risk and return inside an equity fund?
For an equity fund, it really comes down to three things. First, how diversified or concentrated is it? Second, what's the market capitalization of the stocks they hold? Are they large, mid, or small cap? And third, what's their specific stock picking style? Growth, value, momentum.
Let's talk about concentration. If a manager runs a really aggressive concentrated portfolio, what's the immediate danger there?
The danger is magnified unsystematic risk. In a concentrated portfolio, maybe holding only 15 or 20 stocks, the poor performance of any single one of those companies is going to have a huge, violent impact on the whole fund.
Whereas in a diversified fund, it's just a small ripple.
Exactly. Concentration can lead to much higher returns if you get your few bets right, but it dramatically increases the risk and the volatility.
Okay, now let's switch to debt portfolios. The drivers there are completely different. What are the two main factors for a bond fund?
It comes down to the security's credit rating and its tenor. The credit rating is a measure of default risk, the chance that the company or government that issued the bond won't be able to pay you back.
So a lower rating means higher risk.
A lower rating means higher default risk, and because of that, it has to offer a higher potential return, a higher coupon, to convince you to take that risk.
And the tenor, the time to maturity, how does that affect risk?
That drives what we call interest rate risk. And this is a really key concept for bonds. There's an inverse relationship. When market interest rates go up, the price of existing bonds goes down.
And vice versa.
And vice versa. A bond with a longer tenor, say a 30-year bond, is much more sensitive to those interest rate changes. So longer tenor means more interest rate risk, which also means higher potential returns, but more volatility in the bond's price.
Let's talk about that for a second, because it's a bit counterintuitive. How can you actually get capital gains from bonds when interest rates are low and the coupons are tiny?
It's all about that inverse relationship. When a central bank pushes interest rates down, yes, the income on new bonds is very low, but that environment of falling rates pushes up the market prices of all the existing bonds, especially the older ones that have higher coupons.
So you make money on the price of the bond going up.
Precisely. That capital appreciation can be a huge part of a bond fund's total return, often much more than the low periodic income it's collecting. Managing rate cycles is a huge part of bond investing.
Okay, we have to bring this all back to the most critical test of all, the very first question you should ask before you invest.
Absolutely. You have to ask, is the return I'm earning actually enough to beat the effects of inflation?
Because if it's not, you're losing money in real terms. The number in your account might be going up, but your purchasing power is going down. You're getting poorer.
And this is the hidden danger of so-called safe or guaranteed return products, like long-term fixed deposits. They offer predictability, but they carry the risk of being inadequate. In a high inflation environment, that fixed return might not keep pace, meaning the real value of your money is just eroding away year after year.
A guarantee is an illusion of safety if the real risk is just failing to grow.
That's a great way to put it.
So once we've cleared the inflation hurdle, we have one last one, the tax man, which means we have to calculate the tax-adjusted return.
Right. The tax-adjusted return is what you have left after you've paid all the taxes you owe. It's the only number that tells you what you actually have available to spend or reinvest.
And this is so important when you're comparing different types of investments, like a taxable corporate bond versus a tax-free municipal bond.
You have to normalize them. You have to do a tax equivalent calculation.
Walk us through the example from the sources. An investor's in the 20% tax bracket, and they're looking at a tax-free bond that pays 8%. How do they compare that to a regular taxable bond?
Okay, so to find out what a taxable bond would need to pay to give you the same net income, you take the tax-free yield, which is 8%, and you divide it by 1 minus your tax rate.
So 1 minus 0.2, which is 0.8.
Exactly. So you take 8% and divide it by 0.8.
Which gives you 10%.
It gives you 10%. So for that specific investor, A fully taxable bond would need to yield 10% before tax to give them the same 8% in their pocket as the tax-free bond. It's a fundamental step to make sure you're comparing apples to apples.
Okay, this has been an incredibly deep tour of professional evaluation. To just try and synthesize this for everyone listening, we learned that a return is complex. It's made of income and capital gains, even the unrealized ones. We need to standardize with annualization and use KGR for long-term growth, but we have to be wary of its average trap.
And crucially, we define risk not as loss, but as deviation. We quantified it with standard deviation for total volatility and with beta for just the market sensitivity. And most importantly, we landed on the Sharpe ratio as the ultimate metric for measuring risk efficiency. It tells you the quality of the return.
And before you even look at a product, you have to look at yourself first. Let's just reiterate those 3 steps you have to take before making any investment decision.
This process is essential. First, you have to rigorously assess your own return needs and your own risk preferences. You have to be honest with yourself. Second, you match those needs to the right investment options. Equity for growth, debt for stability.
And only then,
as the third step, do you evaluate the specific product using these risk-adjusted metrics, like the Sharpe ratio, against a relevant benchmark. It has to start with you, and it ends with objective measurement.
we've reached the end of our deep dive, but we want to leave you with one final thought. Something that connects a few of these concepts for you to think about the next time you look at a performance report.
We established earlier that the power of compounding depends on the rate of return, the time period, and also the frequency of compounding. Generally, the more frequently you compound, the bigger the final number gets.
At the same time, we spent a lot of time talking about how KGR, that smooth average return, completely hides the volatility underneath, the deviation from that average.
So here's the thought to consider. When an investment has very high volatility, I'm talking sharp, daily, even hourly swings, and the compounding is also happening very frequently, how do those two things interact? Since we know that small losses are mathematically devastating when they're locked in frequently, does that high daily volatility, even if the long-term KGR looks good, does it risk destroying your long-term final value more than it would in a low-frequency compounding situation?
So the very choppiness of the ride could be mathematically eroding the power of the compounding engine.
It's a question that connects the physics of growth directly to the turbulence of the market. It forces you to think about volatility not just as something that makes you uncomfortable, but as a potential mathematical constraint on your wealth.
A truly fascinating point to end on. Thank you for joining us on the deep dive. We'll see you